Everyone is talking about gold right now. The rally has been incredible, and I keep seeing the same comments, the same posts. Traders are already eyeing $5,000 as the next big target. The sentiment is completely one-sided. But that's exactly when we need to ask the question nobody else is. Nobody wants to say it out loud, but gold at $4,000 is expensive insurance. Really expensive. And here's what everyone's forgetting. You only need insurance until the crisis passes. Okay, a quick note before we get into it. This video is all about a potential future event. I want to be very clear that this is a what-if scenario. None of this is a done deal yet. It's about thinking one step ahead of the market. Let's reframe what's happening. When gold hits, say, $4,000 an ounce, it's no longer just an inflation hedge. It's not just a safe haven. At that price, it becomes expensive insurance. It's the market pricing in a truly catastrophic scenario, a major financial crisis, a geopolitical disaster, a complete loss of faith in central banks. You are paying a massive premium for protection. So at $4,000, gold is pricing in catastrophe. Market collapse, currency failure, economic disaster. It's not pricing in normal uncertainty anymore. It's pricing in the worst-case scenario. But what happens when that scenario doesn't arrive? But here's the critical thing about insurance that no one is considering. You only pay for it as long as you need it. The moment the crisis passes, you cancel the policy. So, what happens if the worst-case scenario doesn't happen? What if the Fed, against all odds, actually navigates a soft landing? What if inflation cools without a deep recession? The need for that catastrophic insurance policy evaporates. And when that happens, gold won't just gently pull back. The reason for holding it at such an extreme valuation disappears overnight. That premium that was priced in for disaster. It gets wiped out. Gold would reverse, hard and fast. We're talking about an air pocket opening up below the market, catching everyone by surprise. If the Fed pulls off a soft landing, and they might, gold reverses hard. Fast. No warning. Because insurance you don't need becomes dead weight instantly. The same fear that drove gold up will drive it down twice as fast when confidence returns. Traders are already calling for $5,000. $5,000. That's not fundamental analysis. That's momentum chasing momentum. Sentiment has completely detached from value. And when sentiment leads, reality eventually catches up. This is why the conversation needs to change. The real risk right now isn't missing the last leg of the rally up to 5,000. The real risk is holding the bag at the top when the fundamental reason for being there suddenly shifts. The fact that people are already targeting $5,000 is your biggest tell. It means sentiment has completely detached from immediate value and is purely running on momentum and fear. Don't just plan for the rally. Plan for what comes after. Everyone's focused on missing the rally. Nobody's thinking about holding at the top when fundamentals shift. That's the actual risk. Being the last one in when the music stops. Insurance makes sense. Overpaying for insurance when the fire's already out doesn't. Watch the fundamentals, not the headlines, not the hype. Because gold doesn't care about your $5,000 target. This video is about potential scenarios. Nothing has happened yet. We're analyzing what could unfold if current trends continue. Keep that in mind. Subscribe because apparently watching financial content without subscribing is the new normal. Don't be that person. Also, share this with anyone who's been sending you gold bug Twitter threads. Consider it an intervention.